Wednesday, November 11th, 2021, Maneco 64, home of alternative economics and contrarian views. So the Federal Reserve's transitory narrative has collapsed. We saw yesterday CPI, which is the consequence of inflation, of course, rising prices, came out a lot higher than expected. We saw the dollar and especially the major fiat currencies drop massively versus gold and silver or real money. Yes, the dollar was strong, but it was strong against other trashy fiat currencies. That's what we have to remember. I've spoken about this before. Yes, the dollar index is not a bad indicator in the short term, but in the longer term, it's a distraction, as I've said many times. The dollar index was created in 1973, and it started trading at 100. And here we are, almost 50 years later, and we're just below that level. So I would focus on real money. Before I start, though, I'd like to say that I did a really good interview, in my opinion, with Jack Gamble. His YouTube channel is Nobody Special Finance. And we spoke a lot about China, Evergrande, and silver. I highly recommend you watch it. I published the video yesterday. If you haven't seen it, yes, there's a lot about Evergrande out in the last 24 hours. And I think I'll just say that I don't think things are good for Evergrande and the whole international financial system. So back to inflation. And yes, it can be annoying sometimes. I keep going on about, and I have for the last many years, about the definition of inflation that most people, or the majority of people, especially the central bankers, the mainstream economists, they look at it the wrong way. They look at inflation as the CPI number that came out yesterday. Well, that's completely wrong, of course, because inflation is the creation of credit and currency out of thin air, not backed by convertible money, i.e. gold and silver. It's when the central bank and the government just abuse their power to create these legal tender currencies. And what you get is that you get an over-issuance of these currencies, and then these currencies lose value versus first, I guess, it has been financial assets, real estate assets, and now it's losing, well, we can argue it has been losing anyway a lot of value versus the consumer price index or consumer goods or services for many years. But now, and they've tried to hide it, of course, by tinkering in the data, but now they can't even hide that. So I'm going to go back to my Merriam-Webster dictionary for those people who still think we have a deflationary problem. And deflation is just the opposite of inflation. It's the destruction of the currency and the credit, right? It's when you get bankruptcies, is when people pay off their debt. And then prices will start falling, but not all prices. And I would argue, yes, we could see a deflationary environment. And even that, I have a question, because have you ever seen the money supply go down in the last 50, 60 years? I haven't. So before we look at what happened yesterday, just a quick refresh here from my Merriam-Webster pocket dictionary from the early 70s. And it says, under inflation, an abnormal increase in the value of money and credit resulting in a substantial and continuing rise in the generic price level. And I would say that major economists, central bankers, still don't understand this. Is it because they're dishonest? No, I truly think they've been conditioned and brainwashed into thinking that inflation is the CPI, and that's why it's not going to get better. They're behind the curve. And so yesterday, what did we get in terms of prices? Because what we're seeing now is the consequence of inflation. And as I've said many times, inflation's already left the barn, and they're not going to be able to stop it. The only way they'll stop it, and it's going to be very painful. It's going to make the 1980, 82 recession, which was probably the worst recession up until then since the Great Depression. It's going to make that one look like a picnic because the amount of debt in the system and leverage is humongous right now. So I'm afraid the Fed will always be behind the curve. And even if Paul Volcker were to be around, he would have a tough time. And probably he wouldn't have let this get out of hand. And I'm not like sanctifying the guy or anything, because he was one of the major advisors to Nixon in 71 when Nixon closed the gold window. So what he did in 79, 80, 81 was just cleaning up his mess anyway. But so yesterday, these CPI numbers came out. The core number, let's start with the core, which doesn't include food and energy. That was expected to come out at 0.4 month on month for October and 4.3 year on year for October. And it came out as 0.6 and 4.6. So yeah, a little worse than expected or higher than expected. But the real shocker was the CPI, the headline number. And it was expected 0.6 month on month and 5.8. And it came out at 0.9, 6.2. So the fact that you've got a 6 in front of the decimal is huge. It's the highest CPI reading since 1991, 30 years. So what was the initial market reaction in terms of bonds, gold and silver? Well, I saw that gold and silver actually got hit right after the number. Gold was trading around, down about 8, around 18, 22, 24. I saw that the bond market yields were up a little bit, but not that much. So bonds got sold off. But then it all changed even before the stock market opened at 9:30 a.m. New York. We saw gold blow through that 18, 32, 33 level that I was talking about. We went to like 1842 when it broke that. It went straight there. I said there were going to be stops there. And then as the day went by, as the stock market opened in the US, the domestic markets in the US opened, we saw gold and silver go ballistic. Gold went to a high of 1868 and silver went to a high, I think, of 2512. And more importantly, I think the normies, if you want to call them, the mainstream, they're finally waking up to the fact that the Federal Reserve is losing control of things. And it could lose control of things even more. Well, it might not seem like that, but there are people who think that Brainerd will be the next chairwoman of the Federal Reserve when Jay Powell's term ends next, I think, February. And she's an uber dove. But as you can see here, the bond market kind of woke up. It wasn't just the short end or the belly of the curve, as it's called, like the 3 to 7 year. It was also the 10-year, the 20-year, and the 30-year, as you can see here. The 10-year yield spiked 12 basis points. It finished almost at the high of the day there at 157. And we saw the 5-year and the 3-year up about 14 and 16 basis points. So yeah, the curve did flatten a little bit, but the yields went up all around. And why is that bad? Something going up? Well, because that means that bond prices went down. That means that if the Treasury wants to issue more debt, like it has to, of course, it will be paying more because when the Fed issues new debt, the coupon on that issue has to match yields in the market. That's how it works. So what's the market telling us? Well, they're telling us that maybe the Fed should taper a bit quicker. But if the Fed was really concerned about fighting its own inflation, because we know that it's the Fed and the government that create inflation, and the banks as well, but the banks wouldn't be able to do it if the Fed didn't give them the easy monetary conditions, right? I would say the Fed should end QE right now, so do away with taper and just say, we're not going to do QE anymore. You don't have to wait until 8 months forward to finally stop doing QE. You can do it right now and then come out in an emergency meeting and raise rates to 2%. Yeah, but they can't do that because that would collapse everything, especially with what's going on with Evergrande. There's a lot of, how can I say, it's not very transparent because there's a lot of big banks, especially HSBC, who have big exposure to Evergrande. And HSBC is part of the too big to fail. And if there's trouble with HSBC, you can bet there will be trouble with all the major Wall Street, City of London, and European banks, the ones that are significantly important financial institutions. So that's what happened. And I don't expect much of a fight from the Federal Reserve, nor the other central banks. Unfortunately, we're going to continue to see rising prices. And yes, I've heard that there's a lot of blame being put not on the Federal Reserve or the government, and the fact that they had the huge stimulus last year of fiscal and monetary. They're blaming it all on the crisis, health crisis, on the disruptions. Well, it's not surprising that they try to find scapegoats. And they never blame themselves, of course, but we know who are the culprits. And I think when the majority of people out there start to realize that, that's when you're going to see gold and silver really go through the roof. And yeah, so hold on to your precious metals. Keep stacking gold and silver. Yeah, that's the way to do it. You got to take it out of the system. You got to take your fiat currency out of the system and buy physical silver and gold. So with that, let's quickly look at where the markets are this morning. It's 8:20 a.m. London time. We've got spot gold at $1855.50. It's up $6. The high has been $1858 and the low has been $1842.70. In terms of levels now, of course, 1833, that will be support now, and 1868 or 70 or thereabouts will be resistance. That was yesterday's high. Silver is up 1% this morning. It's up about 25 cents at 24.86. The high's been 24.99. The low overnight has been 24.57. What about the stock market? Well, we've got the Dow up 24, the NASDAQ 100 future up 48, and the S&P up 9. The FTSE is up 43 at 73.59. We had some UK GDP data today that came out early. The FT reports UK economic growth beats expectations driven by health and construction. And then I had a look at the numbers themselves. And this is what investing.com says. GDP for the UK, quarter on quarter, third quarter, was expected 1.5%, came out 1.3. Year on year was expected 6.8, came out 6.6. And then we also had industrial production numbers and manufacturing production numbers for the UK. Month on month was expected to go up 0.2 industrial production, came out minus 0.4. The manufacturing production came out at 0.1, and it was expected at 0.2. So I'm not sure where the FT is getting its data and the expectations. I think it smells a little bit like propaganda for me, trying to embellish the UK economy. And yes, the dollar rose, or the other currencies fell sharply yesterday, especially the euro and the pound, but also the yen. I think the euro and the pound were down about 1%. The yen or the dollar was up about 0.8 versus the yen. But gold went up against all currencies, as I said, even the dollar. And we've broken not just key technical levels on the price of gold in dollars, but also of the price of gold in sterling, in euros, in Japanese yen. And I think that's very bullish and very bearish for fiat currencies. All we're seeing is what I've said many times in the past, that all fiat currencies are sinking versus real money. So this morning, the dollar's continuing higher here because sterling is down 0.25% at 133.73. We've broken key technical support here in sterling, as you can see by this chart. The euro is down about 0.16% at 114.59. The dollar is up 0.14 versus the yen at 114.06. So let's look at some other currencies here. Aussie dollar is down 0.5% at 72.90. The dollar is up 0.25% versus the Canadian dollar, 125.27. And the Kiwi dollar is down 0.5% at 70.23. To the general commodities, crude oil is up 0.33% at 80.46. High-grade copper is up 1% at 4.36. And natural gas is up almost 2%, back above $5. We are at 5.02. And to finish off, we're just going to have a quick look at the 10-year yields. I thought the Treasury market might not be trading today because it's a holiday, a federal holiday, Veterans Day, but it looks like it is trading. The 10-year yield is up just over 1 basis point at 157. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.